Hi, this is James A. Full Capital, and I got my buddy Jeremy Roll um, on today to talk a little bit about. He doesn't even know yet, but I prepared some good stuff for him. And I figure what we do, Jeremy, is a lot of stuff is going on with the market. A lot of stuff, is going on with multifamily. But maybe to kick it off, give people a little bit of your background, and then we'll jump into some slides here.
Sure, absolutely. First of all, thanks for having me on. I hope this is helpful for everyone who's listening. And I do want to just tell everybody the disclaimer. I have not seen anything of what James wants to talk about. So hopefully I'll be able to add some value here. So my name's Jeremy Roll. I'm located near Los Angeles. I've been a passive cash flow investor in real estate and other types of businesses since 2002. And I've been doing it full time. It got me out of the corporate world in 2007. So I've been doing it full time 15 years, but overall 20 years. Definitely interesting times right now to discuss. I also have an MBA from the Wharton School. I'm originally from Montreal, Canada, but I've been in the US for about half my life now. And I manage a group of over 1,000 investors who are looking for similar opportunities to me, which is low risk passive cash flow. I really look for predictability. That's what I'm looking for, and stability.
Well, every month or every quarter, I usually call Jeremy and we just catch up on stuff. And I figured, why not record our conversation? Because I thought it'd be even more entertaining for everyone else out there. So I'm going to pull up some slides and we'll just go through that. And here, let me see if I can do it here. So give me 1 second and I'll pull up the slides here. Okay. So this is how I thought can you see that okay?
Yep.
Okay. All right. So I figured we start sort of macroeconomic. I pulled out some deals that I've seen and then maybe some best practices that you've seen from the GP LP side. So that gives you a little bit of a framework of where we're going on this journey. So on the macro, I want to start with this slide, our favorite slide up there, which is the SOFR forward curve. And obviously everybody tracks this, whether GP, I guess some LPs look at it, but GPs track this, I feel like almost daily. I pulled it down from yesterday. And so I'm not going to try to lead you with any question. When you look at this, what are your thoughts? Like, what are you thinking when you see this?
All right. Well, the first thing I'm going to ask, because it actually is coming to my mind, is what is this exactly? Because this looks like great software to track this.
Okay, so this is a projection of the SOFR forward curve. Yeah.
No, I'm talking about what is the software?
Software. No, this is just a screenshot. I just pulled this off a website.
Oh, off a website. Okay. All right.
Yeah,
Never mind. I thought you were using special
So
software.
it's not moving. Yeah, it's not moving in real time, but it updates every day. Yeah, it updates every day. And, based on, if there's a Fed meeting or just what the market is feeling. So go ahead. When you look at this, what are you thinking?
Okay. And you got the Fed dot plot on here. That's what those dots are. Got it.
Yeah.
Okay. So, look, first thought comes to mind is that this has changed pretty substantially over the past 6 months. And I don't mean that as if, the Fed just started raising rates that made it change. I mean, it's actually changed since the Fed started raising rates. Okay. That's really important for everyone to keep in mind, because if you're just going to take this snapshot and say, this is what's going to happen, this is a very dynamic situation right now. And Powell has told people over and over, they're completely data driven and they're going to adjust based on the data. And they have adjusted based on the data. So first thing coming to mind is take this with a grain of salt, because this is good guidance. And it's actually probably very accurate guidance for today. But the problem is tomorrow something can change, right? And so I would tell people that you've got to, because I'm very conservative, so I'm prejudiced against, for being conservative, but you got to be conservative and assume that this is a probable scenario at the moment, but also that there is risk on the upside. There's also risk on the downside, but I'm much more concerned about the upside and the downside, right? You'd rather not get it wrong on the upside than the downside here, right? Because you'll benefit from the downside probably. So,
yeah, if you go back to sort of October 2021, this line was below this 2%. It didn't even hit 1% a year ago. So it changes dramatically. So
but I want to point out though that if you would look at this in April, okay, of 2022, it would look different. And it would actually be understated, meaning it would actually be wrong on the downside, in that it was showing that the rates are going to be, the forward rates are lower than what they're predicting today by a substantial amount. If we were to pull that data, I would say it's probably going to be off by 100 to 150 basis points, is my guess. Okay. And so that is a huge swing as far as impact on the market valuations and people's decision making. So just be very cautious with this right now. It's a very fluid situation. That was my point.
All right. So we'll try to spend a couple minutes on each one, but yes, it is changing rapidly, and people have to adapt to this sort of forward curve. If you are on any sort of floating rate debt, this is what you're looking at pretty much day in and day out, and this is going to drive the cost of your interest rate cap. All right. So people always ask me, like, do you watch anything on Netflix, or do you watch anything on TV? And I'm like, no, I watch the 10-year Treasury. So the 10-year Treasury has been a hell of a run this past month. And what are you thinking when you look at this thing?
Yeah, this is a good one. And again, same thoughts I had before. It's funny, James, I actually check it more than once a day. It's except for the weekend, but so obviously this gives us good picture about, this is a really good representation this year about how much rates have gone up. I think that one thing that's important to keep in perspective on the real estate side is that if you run formulas, even though going up 1 or 2% doesn't sound like a lot, on a percentage basis, meaning percent increase, it's highly substantial and has a huge impact. And the other thing that this has caused is impact on lenders' concern, tightening up the market, the lending market, getting worse terms, debt coverage ratios. There's so many things that are implicated here. This is also drastically impacting auto loans, which are in a huge distress at the moment, and I think is going to have a significant impact this time around on this downturn. You're going to see a lot more headlines about that in the next 6 months. It's having an immediate direct impact on that. So the next thought I have is, where is it going, right? And that's really tricky. Again, theoretically, it flows somewhat proportionally to the previous chart that we looked at. Obviously, the other one was a forward, but if you ask me, again, I would be concerned about it going higher rather than lower, because I think that, in my opinion, Powell has made it clear over and over and over, even though everyone wants to see him pivot, that he's going to stay the course. And in my opinion, and I'm sorry, this is going to sound really bad, but in my opinion, a recession is Powell's best friend at the moment, because a recession would do some of the work for him in bringing down inflation, and he probably knows it. He's not stupid. So to me, I foresee this potentially going up higher, and because of that, I am personally on the sidelines with almost all my investments, waiting to see where this is going to land. And I just want to point one more thing out with this chart. I feel like right now investors are in an interesting position, because if you're concerned about a potential recession, or where interest rates may top out, I feel like the timeline is pretty short to discover that, but the risk is pretty high. Okay. And risk being high, meaning revenues can come down, net operating incomes can come down, interest rates can go up, but the timeline is short, because I don't see us needing more than 6 at the most into next summer from here to see what's really going to happen. And so as an investor, because the timeline's short, my weight is short, but the risk is high, that makes me stay on the sidelines. And this is a chart I'm looking at every day to help me to understand where everything is going. So sorry, it's a little long, but.
So if a recession does hit, this ideally would go down, the same with the previous chart, you would think.
So that's actually a great question, because I've seen 2 Fed officials now quoted in the last week in the media saying that they're not going to lower rates in 2023. And of course, that's dynamic, but they made those bold statements. And if you take that for what it's worth, then I think that it's not that a recession would necessarily cause it to go down. It would potentially cause it to plateau, at least, right? You can't take for granted it's automatically going to go down. I think you can take for granted the fact that it will plateau at some time based on them stopping to increase rates at some point. So does that make sense?
That does. Yeah. No, I mean, going back to this, pretty much all of 2023, you're above 4% on your SOFR. So they're going to pretty much, let's say, hold it there. I think if inflation comes down, they'll hold it there. And then potentially if inflation's back to 2%, they can maybe go back down to more of a
Yes.
neutral 2.5%, 3%. Okay.
My opinion is that that chart is actually understated, meaning that I think that Powell's going to raise for longer than, which is already what's happened. The market's been wrong already. And I think that there's no reason to think otherwise. He's not going to continue. I think he's going to continue for longer because of what he said and for no other reason. And therefore that chart, in my opinion, is understated, but who knows? We don't know.
All right. Yeah, this next chart is, I stole this from my colleague, James Wilson, and you have been telling me this for the last, I feel like 12, 18 or 24 months, but I don't think people understand it until they see it like in real life. So cap rates. So we touched on interest rates for the last couple of slides, but cap rates, at 4%. All right. When you look at this, what does it say to you?
Yeah, this is a fantastic chart. I love this because this is what I was trying to allude to before, that 1% change, right? Who would think that going from 3 to 4% is bringing your billion? I'm running some quick math. What is that, 25% change? I'd love to run the math, in fact, from 33 to 25 million. And so what is that? That's a
7.3. Yeah.
$8.3 million difference on 33. So that's is about 25% change. That is just, I mean, that's just the 1%, right? If we were to fall lock in step with the increase in interest rates, we'd be in a whole different stratosphere. And thankfully that's not happening. But if rates do continue to go up and cap rates, therefore interest rates go up and cap rates creep up, I mean, look at going from 3 to 4.5. And I just want to point something out. In a typical downturn and proper recession, which we really haven't experienced yet, with unemployment going up and all the other domino effects that happen, I would personally expect cap rates to adjust, between 1.5% and 2% total, right? So what I'm saying is that you're going to go from 33 to between 20 and 22. That is absolutely devastating and foreclosure causing for some people, no doubt. Depending on their situation, depending on the type of debt they took, when it's due, the loan to value, all these different factors. So this is honestly, in my opinion, one of the most important charts to understand right now. And that's why I was saying before that the risk is high because of this chart. It's the asset price adjustment that I'm worried about, and compounded with lower net operating incomes by rents potentially going down during a recession. Compounded effect, right? The great thing is our timeline is pretty short to see where this is going to go. So that's what I was alluding to before.
Yeah, I mean, I think in DFW, and maybe you can touch on maybe some other markets, but what I'm seeing right now sort of on the ground is pretty much everything was around a 4 to 4.5 cap, plus or minus, A, B, and C. And now brokers and sellers still want to sell on a 5 cap. So 5% plus or minus 50 basis points for A, B, and C. But if there's not a buyer at that 5 cap level and the seller has to sell, it's going to go to 5.5 or 6. And that's just where it's going to trade. And
so
it just, yeah.
Well, let's take a look at what that really means here, because that $25 million asset price at the $1 million NOI is now at 18, right? And that's about a 25% adjustment we were talking about, right? So if I got my numbers right. So that is just, if you start running the math, I mean, that impact is just devastating on investors potentially. So it's a really, really big deal, and it's happening slowly. And that's the challenge. It always happens slowly. And that's where you have to be so careful, because this is like a slow boil and you're a lobster in that pot. And the question is, when are they going to turn the heat off?
No, they already turned the heat up. I mean, to me,
right. But when are they going to turn it down? Right. That's what I'm saying. Right. And are you really going to end up completely boiled or not? Right. Are you really going to end up completely burned and boiled or not? And that depends on how high these cap rates end up and how high these interest rates go up. Really, that's what it is. So, but it's a slow boil, and that's what's so challenging. It's the slow boil that people have to get their arms around and understand. This is typically an 18 to 24 month adjustment period. And we're only, and by the way, here's what's really nuts. The Fed funds rate, normally when it's raised, there's a lagging effect on the economy of 6 to 12 months. We literally are now recording this in October. The first raise, I believe, started in March, and then it got much more significant after. And if that's correct, we haven't even felt the impact in the economy yet of any of the rate increases so far, pretty much. So everything takes a long time to kind of work its way through, and next year is going to be fascinating to watch.
So if you're a GP, because I get this question asked a lot, is what do I use as the terminal cap rate on a B deal in DFW right now? Like what do you think is a safe terminal cap rate? Because, obviously I'd love cash on cash returns, but the residuals making up a lot of these deals. What do you put that at right now so that you can sleep at night?
Yeah, great question. And I want to clarify, I am not a GP, because sometimes people get confused. I'm just a full-time passive LP, right? So,
right. What do you want to see the GP have in their model on a terminal cap rate?
Yeah, 100%. So that is such a good question. And frankly, I invest in longer term deals normally. So I'm normally in a 10-year deal, and a lot of people may invest in 5-year deals. So it's a little bit different for what I invest in. But regardless, I mean, if you take that 150 to 200 basis point number, just as an example of what I threw out before, right? What typically happens in a reset or in a cycle adjustment, then if your market was at 4, I'd like to see a terminal cap rate at 5.5, possibly 6, but 5. I could probably buy 5.5 on a 10-year basis, which, by the way, is going to kill the IRR and the ROI for the projections, right? To be realistic. So I don't necessarily expect that investors are going to see that baked in at the moment until we get to those cap rates, until they're really forced to show them. Because I think they're going to try to, this is one of the things that this is a huge, important piece of the assumptions that the sponsor can use to mess with the returns, the projected returns, as you know, James. So, but I would look for a really conservative cap rate. I mean, look, this is a very subjective topic. Because I'm conservative, I'm not going to buy someone telling me that the cap rate's going to be a 3.5 or a 4. It just, on what basis? You can look at the SOFR and maybe they can substantiate it there, and maybe they're not wrong. But it all depends on how conservative you want to play this, and how conservative a person you are.
Right. Okay. All right. I think we got that piece. So I just pulled 3 slides, sort of macro basis. What else do you look at on sort of the macro side? So we looked at SOFR, we looked at 10-year treasury, and we looked at cap rate. Is there anything else that investors should be looking at sort of on a macro basis right now?
Yeah. So first off, and I think you probably implied this, but just to be clear, you have the Fed dot plot on there. The Fed funds rate has to be watched very carefully, right? That's the number one thing people are watching at the moment. So I think you meant to imply that in the first slide, but we looked at the SOFR. So, so just that's something I'm obviously following very carefully. Where is the Fed going with this? Another thing that, just to kind of rewind a little, I would tell people, inverted yield curve. What does that tell us? When did it happen? How bad is it at the moment? And that's very important to watch. And so it's one of the reasons why I'm almost 95% convinced we're going to have a recession next year, for many reasons, in fact, but it just happens to line up with that as well, right? So that's always a really important when I watch macro, to give me a good 18 to 24 month, headway, or 12 to 24 month advance notice of what's probably going to happen from a probability perspective. I'm also watching GDP very carefully. I think that, technically speaking, we're already in a recession based on the historical definition. I think that the current, I don't vote, so I'm not making any political statements. I'm just trying to figure out what's going on. But there's probably already in a recession. The politicians don't want to admit it because of midterm elections coming up. I think if we end up with a 3rd GDP negative in a row that's going to print right after the elections, they'll probably admit it. It's very hard for them to say, okay, 3 negative prints in a row. No, we're not in a recession. It's going to look ridiculous. It already looks a little ridiculous already. So I'm watching that very carefully. And I actually watch the Atlanta GDP now several times a week to see what their guidance is. They're not usually dead on, but they're one of the closest predicting parties, I think. So that's a good one to follow. What else? There's definitely more things. Stock market. Personally, I think that the stock market has one more leg down. And the way that you can follow that, in my opinion, is watching the VIX, the volatility index. We have not had a proper capitulation over 40, like you would expect. And because of that, I'm not convinced that the stock market's fully declined. And the reason why that's so important on the real estate side is because I think that's going to impact liquidity. It's going to create fear. It's going to create less interest in people investing money. It's going to create fear amongst banks who are going to have to shore up their reserves. And it's going to have a domino effect on not just the sentiment of the market, but the potential lending in the market, many different pieces. A lot of dominoes fall from that. I think that's going to happen still. And that's when, as an investor, you know that you're starting to get to an interesting place if you're sitting on the sidelines waiting for the buy signal, you know? So we'll see what happens with that, but I'm watching that very carefully as well every day. There's probably more, but those are some of the first coming to mind.
All right. Yeah, even if you're not in the stock market, it still dominates CNBC, and that's all people see. So they just don't feel good, right? So
right, it's all sentiment. Yeah.
Yeah. So we got the macro. Now I wanted to sort of get into deals. I mean, you might have a couple comments on each one of these slides, and I'm not saying these are good deals or bad deals, but I just want to get your thought process on. I'm only going to show you one slide, and it's not necessarily. I just want to see your thoughts on it. So
Sure.
we'll just try it. We'll just try it out here.
This is like rapid fire Shark Tank. So
yeah, so this is the deal summary. So I'll give you a couple seconds. This is 128 units, 1970. They're buying it at a 4.9 cap, 140 a door. And so I think the thing that I wanted to hone in on is that this bottom piece right here. So they have a fixed interest rate. So they have a Fannie Mae loan essentially at 2.99%, and they're assuming that loan on this deal. So we are seeing more of this come into the market just because of where that 10-year treasury has run to. So when you look at this, what questions or what comes to mind when you look at a deal like this?
Okay. Without the benefit of a calculator, I'm going to do some quick assumption running numbers on it. So am I able to ask you any questions?
Yeah, sure.
Is this designed to be fixed rate on debt, the loan assumption? Yep. When is the loan due?
It probably has at least 8 years.
Okay, 8 years remaining.
Yeah.
Okay, that's good. Okay. Based on the renovation budget, it looks like it's maybe 8,500 to 9,000 a door. Okay, if I'm running my numbers right, just off the top of my head. Hope I have that right. Actually, it's even more. It's more than that. Sorry, it's almost 10,000 a door, right? It's 1.2 million divided by 128. So this to me looks like it's a full-on value add deal.
Right.
Okay. Your build, I'm going to assume it's a C-class building based on the age. Is that a fair assumption?
Absolutely.
Okay. So first things first, the projected average annual cash distributions look very low to me on an 80-20 split. Is there no preferred return?
No preferred. This is just a straight 80-20. Yeah.
Okay. So that's the first thing that flags out to me. Now I'm a cash flow investor. So let me actually rewind and just give everybody the caveat. I am a long-term investor. I don't normally invest in 5-year deals. And if I do, it's not at this timing. It's the beginning of a cycle. So I'm the wrong person to ask about this, but I'm going to point some stuff out that I see, right? Because I wouldn't be doing this deal just based on that alone. So I have a requirement to invest with a pref for myself, just for downside risk mitigation. So I would be passing on that because of this. That's subjective. Plenty of people will be happy investing in this deal at the 80-20 split, just telling you my own perspective. But I think that as a result of that, the average annual cash distributions could be low, in my opinion, especially for Class C, if it's because there's no pref, or it could be low because they're overpaying, because I'm looking at the price per unit, looks pretty high to me. Okay, sure. Especially because money has to go into it. And let's see. So the loan is a plus for sure. And I've seen some of these types of deals. The cap rate, I guess it looks okay for today's market. Something is up with the annual average. The average annual cash distributions are low for what I think you should see for a Class C building. And I have to analyze what it is exactly. Because the cap rate doesn't look crazy. You have positive leverage. Sorry, go ahead. Is it because there's no prep?
No. So I think, I know a little bit about the deal. So most of these loan assumptions, the interest rate is lower, but the leverage is not high, right? So you're putting down 35 or 40% on these deals. And so there's just a lot of cash that's going into this deal. And you probably need to do the renovations. So your year 1, year 2 cash flow is
totally
probably
got it. Yeah. Okay. Yeah. Do you actually know the effective LTV on the loan based on that? Is it actually in the 30s and 40s?
Yeah, the LTV is probably probably 60%. Let's just assume
60%.
60%
Okay.
for fun.
Okay.
Yeah.
Okay. So thank you. I just want to point out to everybody, that's how important it is to look at the loan. A lot of people don't dissect the loans. So important. It just even in one piece of a loan like that can have a huge impact. So if you ask me at 60% LTV at a 1970s built Class C, thinking about the fact that cap rates are adjusting and that the pricing could come down or is coming down at the moment, the 6.1% projected average annual cash distributions don't do it for me. But because I think 60% is not crazy low. It's obviously not crazy high. There's some buffer there, but 60% isn't like 30, 40, 50%. So there's a little bit of leverage there. And I wouldn't be investing in a Class C property with that type of projected average annual return as a cash flow investor. It's not high enough.
Okay, so you're thinking if I'm in this deal, I need a preferred return, 7-8% preferred, and then potentially the leverage is okay, but that's the main thing.
I like to target 65 to 70% leverage. So I don't know how much of effect that would have without running numbers on the cash flow. But again, going back to like the risk reward and the timing right now, there isn't enough cash flow in here to make me comfortable moving forward. Just looking at that one number solely, given the year built and given where the market is, putting everything else aside. So
this is why I love the deck 60 pages, and I just pulled out this one page. So that's perfect. All right. This is the next slide. So different deal. This is not the same deal. Different deal, but we're seeing people offer different classes. So they've got the Class A percentage, which you put in 200,000, you get 10%. Class B, you put in 75, you get 9%. And A and B have no upside. And then Class C says, all right, well, you're behind A and B, so you're going to get 7, but you're going to get the upside. So when you look at this, which one do you take?
Okay, but I just want to point something out though. Equity upside only for Class C and D, not
Correct.
A and D.
So A and B has no, the only difference in A and B is
I heard A and D because there is a D, but it's not showing. I'm sorry.
It's not shown. I'm not, Class D might be for, I'm not sure. So
it could be.
Let's just do A, B, and C. Yeah, A, B, and C.
Perfect. Okay. So, well, first thing I'm going to say is, the option to exit in 2 to 3 years, I always get worried about that because how does that structured? How's it going to work? If you're counting on that, you cannot count on that because if there is some type of financial distress, you just have to assume that option goes away, that the documents are such that they don't have to provide you that option anymore. So just be very careful whenever that option is presented. I consider it optional when you have that option from the sponsor's perspective. Number 2, I cannot stress the importance enough of understanding the capital stack in this deal before even thinking about this deal. I don't have that information in front of me, but if you're looking at a preferred equity position in Class A and B, which is basically what this looks like to me, then just because that annualized rate of 20% plus projection looks really attractive in C, it doesn't mean A or B are necessarily the worst choices, okay? Because that 20% annualized return can be comprised of what I call an effective loan to value of 90%. Which means that you have actual, first position loan plus 2 classes of pref equity, which is actually pretty unusual, but I think they're just doing it from a minimum perspective. So it may not be too burdensome. The number one thing I'd have to ask, James, my first question is show me the capital stack. What is the LTV on the loan? How much of Class A and B are positioned to take up the stack in the middle before the equity? And if I'm looking at C, because I always prefer equity myself and not preferred equity, what position am I in? What's my I call it effective loan to value, which isn't, it's not really accurate, but just the way I think of it. So I can understand what is my risk in exchange for that 20% plus annualized return. I'm going to tell you something else too. That 20% plus annualized return right now in this situation, everything we've been talking about, that seems like a very, very fairy tale projection to me. I haven't seen a deal. Maybe this is development, and maybe that's what's going on here, but which I don't invest in. But for someone to put on paper 20% plus right now, heading into a recession that's high probability, heading into cap rate increases, heading into all this uncertainty in a 4 to 5 year projected hold period, I think the probability is below 50% that they're going to hit it, unless this is a pure development deal.
Mm.
Other thing I want to say is that this 4 to 5 year projected hold period, let's go back to what we were talking about in the previous one. You have to understand the debt. Is this a bridge 3+1+1 bridge? If yes, what do the terms look like? They've gotten substantially worse in the last 6 to 9 months. So this slide basically makes me ask a ton of questions as opposed to giving you any opinion about anything.
No, that's exactly the point. I want to hear the question, because I think that's what, like, this might be one slide of 50 slides, but
Yeah.
there's the ability to understand, because most people don't read documents. What they read is the pitch deck. They take the pitch deck, and now, all right, so based on what you saw, what questions should you be asking as an investor? So that's exactly where I wanted to go down the road. So when you're looking at these A, B, and C, do you do A and B, or do you do C, and how do you determine that?
Yeah. So assuming that the combined loan to values, quote unquote, isn't too what's the word I'm looking for? Too high, essentially, right? Too difficult for Class C members to absorb. I always prefer Class C, and not because it is 20% plus annualized rate of return number. It's because I tend to invest in more stabilized properties that may or may not have any value at upside. But if I'm going to take that route, I want to benefit from the upside if it's there, because I'm already going into a stabilized 80 to 100% occupied situation when I invest. So if I'm going to already invest in something that has a little more predictability to it, I want to benefit if there happens to be upside to it. And so I've done some pref equity, the preferred equity stack. It's been in very unusual situations, not in the typical deal that you're looking at here, where I've had 13, 14% preferred equity returns on literally an effective like 48% loan to value situation. Okay. Just giving you an idea. That, by the way, that included the initial loan and the pref equity that I was actually in. That was the combined, loan to value, the position I was in. So I've done really unusual stuff, but I don't like going into the pref equity stack. I find that by the time, I feel like at a 9 or 10% return, you're not getting compensated for the risk of the entire deal. That's my opinion. And I also, because I go into that stabilized stuff, unless like there's some unique thing about it with the loan, like I was saying, if the risk is much lower than I'm assuming. Otherwise, I strongly prefer to be in the equity class.
Yeah, we're seeing like we've asked, or people have asked us to place some preferred equity, and a lot of times it might be 7 or 8% current, but then the larger pref equity shops right now are asking for a catch up or a deferral of the remaining 7 or 8%, so they're getting closer to 15% to be in that part of the stack right now.
Yeah.
So
yeah.
Yeah,
and I want to point something out to everybody. Okay, let's rewind a few years. When did pref equity start to get really popular? Let's call it 2017, 18. Okay, it could be off by 1 year. Why did that happen? That happened because we were getting towards the end of a cycle. Everything was getting really expensive, and sponsors had to find a way to make deals enticing enough from a cash flow perspective for people. So they started to be able to advertise these 9 or 10% pref equity returns. That was really great cash flow because they couldn't generate that level of cash flow from the deals because they were buying at a very expensive time. So this was financial engineering to attract investors. If I had to guess, and again, I have one slide out of 50, what's going on here most likely is that there is probably, based on the 2 to 3 year option to exit, which is probably when it's going to be a refi, okay, because I can't really think of another reason, there's probably a 3+1+1 bridge loan that somebody is getting a lower loan to value on because loan to values have come down on the bridge loan, that they're trying to plus up in the effective loan to value to get it to where they need to get it, to get that decent return scale for the actual equity investors, right? So again, financial engineering, because the lenders are saying, this is a risky time, you can't get as much capital now. And what they're doing is they're stuffing in class A and B to make up for the difference. And so from a risk perspective, so that's a guess, but that's probably what's happening here.
All right, perfect. So let me hit the next one here. So you maybe covered this. This might be a short slide, but I'll give you a minute to look at it. But pretty much this is a development deal.
Yep.
0, negative, and then 1.3, and then 3.4 in NOI, and you
Yep.
sell the deal, and you make $36 million.
Okay. Is this multifamily?
It is a type of multifamily. So I think this particular one is like a senior
I knew it.
housing.
I was
Yeah.
going to say
Okay.
senior. So
Yeah.
because, and the reason why I know that sounds weird to people watching this, but the one thing I was going to say is that if it's senior, then it changes the game on doing a development at this stage, because senior housing is projected to have a huge increase in demand based on the aging population between 2022 and 2032. And so building into that time makes a ton of sense, even potentially into a recession, because there's an increasing need putting the recession aside, right? And seniors are on a fixed budget and or possibly through Medicare, and or have put themselves into a retirement position where they can afford this, where they may be less susceptible. It all depends on how they're positioning this. Are going to take private pay, public pay, accommodate? There's a lot of questions to ask about this, okay? But I've never invested in development, so I'm the wrong person to give you perspective on this. I will say that if you look at the projected IRRs without really looking at the assumptions, I would say that at least it looks like you're getting decently compensated for the risk of development. I would say that doing
This is
development
down
at this time
here.
in
This is
um,
is this what you're talking about?
yeah,
23%
yeah,
IRR, 2x
yeah.
multiple over
Yeah, I
4
mean,
years.
again, I don't know how
Okay.
much leverage, and I'm just making a blanket random statement, but at least you're going to get compensated. It looks like to me decently for taking the risk relative to going into a more stabilized deal that's typically going to be under 15, right? At the moment, realistically. One thing to note is that if you're going to go into this deal, I always tell people doing heavy value add or development is typically the lowest risk, all else being equal, and not taking other factors into account at the beginning of a cycle versus the end of a cycle. And I liken this to being an airplane trying to take off on a runway. You're giving yourself the shortest amount of runway as you get towards the end of a cycle before you have to take off or fall off the cliff, because things can go wrong if there's a recession, as far as lenders giving you your next construction tranche, as far as rents adjusting and not being what you projected and not being able to hold to the deal on the debt coverage ratio requirements, all kinds of things. So it's almost like you're going against headwinds instead of tailwinds when you're going at the end of a cycle in this type of deal instead of the beginning of a cycle. The exception here could be the fact that it's senior. That changes a lot of things and a lot of considerations. If this wasn't senior, I have a very different opinion on it, but I also can't give you much of an opinion because I don't invest in development.
All right. They're using a 5 cap on the end of this thing. So new construction 5 cap just in month 40. Just FYI on that one. So this
month, yeah, that's about 3.5 years out. Yeah. I mean, look, at least it's not a 4 cap or something, right? So to your point, what I would do, the first thing I would do is ask him to run it for me in a 5.5 and a 6 cap, assuming it's in the market we were looking at before, to determine the sensitivity of the IRR. And if you start to drop into like 15 to 18%, then I would start to question whether you really get the risk premium for this deal.
Got it. Yeah, because if you're getting a 15% IRR, but you're taking the whole risk of development and lease up and everything that goes along with it and the construction loan and all that, then all right. So this is so it's almost like I'm giving you pieces of different deals to make it harder on you. This is the same deal
okay,
that we showed before, but this is the sources and uses of the deal. So they're getting 62% on their debt, and then they have a pref equity piece of 11.5, and this is your total equity piece of 8.4. That's you as the LP, right?
Okay. Got it. So
Okay.
yeah, my first reaction to this is going back to what I said before. Now all of a sudden that 23% projected return, especially if you start running the sensitivity to 5.5 or 6 cap, okay, and you take into account that you're an effective LTV of what I call 84%. I know, I'm sorry, that's not really accurate, but it's what I call it. Now, to me, that risk doesn't make sense. It does not make sense, because you're probably going to end up in an IRR projected of somewhere between 16 and 21, I'm guessing, once they revise the projections for you. And it just, the risk reward isn't there to me at the 84% LTV on a development deal like that. Now, I'm biased towards being conservative and everything else, but if I'm looking at a spread, at least, that is very difficult for me to swallow.
Got it. This is like 10 minutes from my house. That's the only reason I was looking at it.
There you go. I just want to tell everybody, everything that James just invested in the last 2 months apparently is what I told him not to do apparently right now. So that's a surprise.
No. This deal just came out. This deal just came out. And no. Just the location is 2 minutes, or not 2 minutes, but like 10 minutes from my house. That's why I thought it was interesting. But just also from a price per door, I mean, they're essentially building this new senior housing facility for 281 a door. So just rough, giving people an idea of sort of what it costs to build. And this is probably nicer than most deals. So all right, let's keep going.
Okay.
So this is a fund,
Okay.
and I just pulled one of their slides, but it doesn't really matter about the fund. But I'm just saying, investing in a fund versus individual deal,
Okay.
and what your thoughts on, well, have you done funds and versus just doing an individual deal, 50, 100,000 at a time, or putting 100,000 in this fund. Like this fund looks like it's going to have 5 properties, right? And pros and cons either way.
Yep. So this doesn't matter. You don't want me to comment on the fund or whatever. This is just the concept of the fund.
Yeah,
just
the
a random
concept of the
example.
fund. Yeah.
Okay. So I want to point out that a fund is, all things being equal, easier for a sponsor to run than having to raise on a property by property basis. Okay. So what you'll find is that there are more funds available towards the end of a cycle than the beginning of a cycle. And that's because it's the easiest time for sponsors to raise money. And if they're in the driver's seat, they're going to take the easier path themselves. That makes perfect sense, right? I also want to point out that on average, if I have talked to hundreds or thousands of investors over the years, and by the way, I should answer the question. I've been in over 150 to 200 different deals over the last 20 years. So I've been in many funds and I've been in many single properties. Okay, so I'm definitely familiar with both. Most investors, more than 50% of investors I've spoken to, whatever the percentage is, would prefer to be able to evaluate an individual asset instead of a fund. That being said, if you put someone in the position where they've invested with a sponsor multiple times, really like what the sponsor's done, and they're very comfortable with them, probably at that point it flips to where most investors would actually prefer to then be able to make a bet on multiple properties in a fund and get more diversification with that sponsor that they vetted and had many years of experience with. So it's a bit of a, it depends on the scenario. I think what you're going to find is that we're going to have more individual properties and less funds out of 10 deals out there as soon as we get this fear that I mentioned and the increase in the volatility index. And I think it's going to take several years for that to change again. I am not at all opposed to a fund. One way you can, if you're concerned about investing in a fund and it's a blind pool or a semi-blind pool, meaning you don't know any of the properties, you know some of the properties, one thing you can do, which is what I tend to do, is you can wait and forego some of the preferred return or whatever the cash flow might be until towards the end of when it's open, and then get a better look at all the properties, right? If you don't know the sponsor that well, and get a better sense of what you're actually investing in to decide if it's the right fit for you, right? Because that's the one big cons of funds, is that you're often investing not knowing either some or most of the properties you're going to invest in, which is challenging. Pros, great diversification, but cons is sometimes you don't know what you're investing in, and that could be a big challenge.
So at the end of last year, there was a general partner here in Dallas, and I had invested in individual deals with that person, and they were like, "We're going to do a fund, and this is the only way that you're going to be able to invest with us. We're doing a fund." And so they raised all the money, and it came in probably February, March of this year, and they deployed all the money, 250 million, in 3 months, March, April, May. And you know why they deployed all the money? Because they had the fund. Would they have bought all of those deals in March, April, May, June of this year? Probably not, right? So that's my only concern, is when you go into a fund and you hand over money and then they're just like, "We're going to deploy this thing." It is very difficult, I think, to say, "All right, we raised all this money and now we're not going to buy anything."
Yeah. Right? So
you
know what? That is actually a great point. But I've actually been in the exact opposite situation, just so you know, where there was a timeline of projected of 1 year to buy X number of properties, and it took 1.5 years or 2 years because they were being really careful. As a result, because you made a bet on a 1 year timeline, your cash flow was lower than the projected amount because they didn't actually have all the income producing for the properties they didn't buy, right? That they should have bought in the timeline. It was a good reason why they did it. but it's actually a similar result. It's a bad result in that you've now lost time on cash flow for a good reason. But had you done individual properties, you wouldn't have any of that, right? So
Right.
two
Yeah.
problems or two challenges that are different that both James and I just pointed out that you can have going into these funds, especially early on. So it's a good point. You really have to get to know someone well enough to judge whether they're going to do that or not, right? If they're going to, and to be honest with you, so I understand something. Did they raise all the funds and then deploy the capital, or were they trickling the capital in?
So I think it was one of these where you could commit to the capital, let's say in January of this year, right? And then they were going to call your capital when they needed it for deals. But the calls came so fast that essentially it was pretty much all deployed, right? Like
Okay,
they made the
that's
call in
interesting.
March, they made it in April, they made it in May, like so pretty much it was all deployed.
So
Because
there's
yeah.
another way it can be done that I prefer, that I see, but just I prefer, and I see a little bit more commonly, but more probably because I'm looking for those types of deals, which is I've seen situations where, say you and I, James, want to invest in this fund and we both put our hand up, but I put it up first. So they come to me in February and they say, okay, Jeremy, we're ready to take your full 50,000 or whatever number it is, right? They turn to James and say, not yet. Sorry, like we got to find some more properties. And then they go to James in June and they say, okay, ready for you now. And everyone's just in an order, but they're not taking tranches. They're taking full amounts from people. I don't know if that could really impact the situation or not, but that's what I prefer to see myself, even because I don't like the idea of someone calling funds at a random time. I'm not sure when it's going to be. That's just another unknown to this whole unknown fund thing, right? So
Right.
I'm not sure that really helps to prevent what you're talking about, but it's more commonly what I tend to invest in.
Yeah, and I think like the fund model worked for this group because they probably were trying to go out and raise $10 million checks, not $100,000 checks. You know what I mean?
Yeah.
So that
Yep.
just for someone
Yep.
trying to deploy that amount of money, they're probably like, well, I don't want 10 million in one deal, but you're gonna buy 20 deals. Like that makes sense to me. I'll do 500,000 a piece in those deals. And so I think maybe on a larger scope, those people, it works well. So all right,
Yeah.
we beat that to death. All right, strike. So when you're buying a deal, you have an option, right? So you have the option of buying an interest rate cap, and this
Mhm.
goes back to the SOFR curve. And so this general partner was basically saying, look, if I buy a 1% strike, it's going to cost me $1.9 million. And the projected payout based on the forward curve is 1.9. So essentially, all the money that I pay out, I get back. But if I buy a 3% strike, it's going to cost me 550, but I'm only going to get paid out 118. So they raised the money for this full cap, 1.9 million, to get a 1% strike so that their
Mhm.
SOFR was capped at that number.
Mhm.
So when you see this, this was on a bridge loan. So they're buying a 2-year cap. Which do either of these make you feel more comfortable or less comfortable?
Yeah. So I'm gonna just this is the first I'm gonna do this to you, but I don't invest in floating rate loan stuff. I'm looking for predictable, so I always invest in fixed. I've never analyzed these scenarios, these two. I understand what they are and how they
Yeah.
work, but I've never analyzed the opportunity cost of one versus the other. So I want to be fair to everybody out there and say I am the wrong person to answer this question. I'm sorry, James.
Okay. All right. But you understand where I was going with it. So
Yeah, why don't you give
perfect.
us, you've been taking my opinion. If we had twice the time, I would have been forcing you to get your opinion is either the same or better than mine in all these things, because you got a ton of experience. Why don't you give everybody your opinion on this?
So this one, if you can raise the money at the 1.9, like if you can raise that 1.9 million and basically, like let's say your spread was, let's say 350, right? And you buy a 1% strike, then effectively your interest rate for the first 2 years is 4.5%, right? And that mitigates a ton of risk. And so there's a lot of general partners who can raise that money and they have no problem raising that money. But there's other general partners who are short on equity right now. Like we've talked about lenders holding back money or limiting LTV. So they don't even they have 500,000 to spend on a cap and that's all they can buy. Right. So the first thing is, can you raise the money? The second thing is, this looks great, right? If you spend the 1.9 million, if the Fed cuts the rate let's say in 12 months, and it drops all the way down below your strike, I don't know if it's dropping below 1%, but it could drop below the strike. You've
Yep.
basically spent all that
Yeah.
money, and that
Right.
money could have went into capital of the property, but
Yes.
your cap value has basically gone to zero. So that's what it did. All of, when federal funds got cut all the way to zero, they basically threw everybody's cap in the trash, right? Because it didn't cost anything.
Yeah.
So I'm
So
probably closer to this camp if I can raise the equity.
Yeah. So let me just say this. For those of you not familiar with this, what essentially is happening on the left is that you're basically buying an insurance policy, and sometimes it pays off and sometimes it doesn't. You're buying an insurance policy, you're hedging. It's almost like someone, some airlines, a lot of people probably don't know this, will buy the option to buy oil at a certain price in the future to hedge their gas prices or their fuel prices. And sometimes they win and sometimes they lose, right? And it's the exact same idea here. But if you're conservative like me, you're always going to choose the left column. I don't want to say that because I also have never run an analysis to understand the difference in the risk and the reward and everything else. But in reality, that's basically what James is saying here on the left, which is really an important thing to understand here.
Right. I just thought it was an interesting way this GP phrased it. And this payout is completely based on the forward curve. So if the forward curve changes, like we talked about, it always changes. It could go to zero.
Yeah. So, yeah. 100%.
So we'll touch on this briefly. So this is that development deal. And have you done anything past, like, I'm usually in this bucket right here, but have you done anything in this space to the right or no?
Yeah, I'm currently in several deals that are in those buckets.
Okay. Any comments? It looks, is this a good way of thinking about it? In terms of the different, like, I've always just been scared because I'm just like, it takes too much, the rent's too high, and then it's too many employees. Like, I was just at a 200 unit property this morning, and it has 4 people, and I'm good with that. But like some of these, it's just going to take a lot of employees to manage all these, and the rent seems high to me. So
the active adult senior living, that's 55 plus multifamily community, correct?
I believe so.
Is that what that is?
Yeah.
Okay.
Yep.
Okay. So yeah. So let's put, well, I'll just give you my high level thoughts on all these. Yeah. So I'm a lower risk investor. I live off of cash flow. I look for predictability of cash flow, right? The closest you'll get to the best level of predictability is in the active adult senior living, which is well known as 55 plus, restricted age community, which is multifamily building, that very commonly can literally just be, you have to be 55 or more to live here. We have an older population community. It's restricted for that reason. And there may not be anything facilities or anything to do with catering to seniors beyond that, even in that facility, but it's a great place for them to live all together. So it could be as simple as managing a multifamily building. It could be as complicated as having a few facilities or offerings that are catered towards that age range, okay? But generally speaking, it's the lowest amount of work compared to independent living, assisted living, and nursing, which is what you're showing here. So as you go towards the right on the arrow, you increase your volatility and risk, you increase your return theoretically, okay? So nursing care takes the most amount of work, is the hardest to provide with the largest amount of staff on everything we're looking at here. And therefore, because of that work, as you can see, the rent is higher. The projected return to investors should theoretically be higher and go up as you go across this arrow. So as an investor, there's 1,000 ways to invest, none of them are wrong. So as if you're looking at this individually, you have to decide, where do I fall on the risk return spectrum here, right? And so, like I told you before, I typically do stabilized or maybe low value add to medium value add, maybe. So I'd be more in the, active adult senior living and independent living camp when I'm investing in these. Assisted living is still not that bad. Nursing care and some other stuff can be much more challenging. But I want to go back to a point that James made, which is a lot of people view these as businesses. And in fact, the way they're structured is that usually the legal structure is that there's the actual management business side that's separated from the property ownership side for that reason, because it's so labor intensive and just different than owning a multifamily building. So there is variability because of that. that right now the industry is experiencing a lot of challenges, even though there's a lot of projected growth in demand. There's COVID, which is causing challenges even today in facilities. There's a nursing staff shortage, right, which isn't getting better. There's very difficult to find nursing staff at the right price as a result, which is impacting NOI significantly in some facilities. I'm making a generalized statement on the non-institutional side. Very difficult to invest in this space if you're looking for stabilized deals, both because there's very few out there. The vast majority of deals are development deals because that's what makes sense for this niche. This niche needs more supply. So most of the deals are development, which is not the right fit for me. So hard to find stabilized or mining value add deals here. Most of those facilities are smaller. They're going to be maybe upwards of 30 units, 40 units. You're not normally finding 100, 200, 300 unit building that is readily available as a stabilized that's non-institutional. So hard to find the level of tenant diversification I look for. There's on the non-institutional side, the management is very fragmented, and property management or facility management is going to make or break your business, even more so than another type of asset typically. And it's very hard to find buttoned up management that is not all over the place. And so in my experience in this, having invested across multiple facilities, I would tell you, if you're looking for more predictable cash flow and lower risk, you got to stay to the 55 plus and maybe independent living. Otherwise, you're starting to get into a challenging space. I am very concerned about the impact of COVID going forward and demand for these and whether people are scared to go in them. And I'm personally waiting a couple of years to see how it plays out.
Yeah, I mean, some of these people couldn't even get in to see their parents, right? Just because they weren't letting anybody in if you were in an assisted living or nursing care facility, just because there's too many people at risk. So, and then, does the rent thing bother you at all? Like just the cost of assisted living or nursing care being like $8,000 a month? Is that, I feel like,
it doesn't bother me to the extent that if people didn't find value in it, they wouldn't pay for it. So because I'm not old, I can't speak to like the alternatives. But what I would tell people, which I didn't cover before, is that one of the very important considerations when investing in these deals is whether you're getting paid private pay or public pay, meaning Medicare, for example, or a combination of both, right? Because my preference is typically private pay in an area that happens to be higher income or adjacent to higher income, where let's say those parents, the kids may live, who may be supporting this or helping them to be in there. Because public pay, who knows what they could just wake up one day and say, we're capping public pay going forward. We're changing the pay scale. Who knows what, right? It's less control over your income. So I tend to try to avoid public pay as a result of that. But to answer your question, I like to think that people are getting the right amount of value for the money they're paying, or they wouldn't be there. So that doesn't bother me, just as being a capitalist, as long as they are getting the right value.
Okay. All right. Perfect. All right. So I don't know how many more slides I have. Hopefully you can hang out for a little bit. So this was sent to me, and essentially I'll try to explain it to you so that you have some context, but essentially this was a bridge lender, sorry. And they were essentially loaning, let's say 70% LTV. And then, that maybe, SOFR plus 4%, they were going to get a warehouse line to do that. And then they were going to securitize it. So at the end of all that, they were going to make about 12%, let's say 12% on your money. So you put in 100,000, you're going to make 12% a year, but obviously there's no upside, right? Because it's debt, right? What have you done anything like this? Or this is just an example, but yeah.
So this is a debt fund that you'd be investing in, correct? Okay.
Yep.
What are they lending against? Fund equity, first mortgage against what's that?
First mortgage, multifamily. Yep.
Okay. So I have not done multifamily.
Okay.
I have not done anything on the debt side related to lending first position except for homes, single family homes. And this is to flippers who are buying and rehabbing and reselling a property. The reason is because foreclosing in non-judicial states where there's all different types of legal documents you get, can be relatively quick if someone is not paying you. You can look at very current comps in a lot of larger markets to understand what it's worth quite easily. You could typically liquidate it fairly fast, even to a wholesale buyer. Like there's a lot of wholesale buyers out there who would be willing to take your position or flip it or whatever it's going to be. I feel like the predictability, if something goes wrong, is much higher than if you own, and even if it's empty, than if you own a multifamily building that has 100, 200 tenants. Own meaning you have to foreclose on it. Okay, that's
Right.
like, you know,
Yep.
your backup. And now you've got certain tenants that are paying, certain tenants that are. You may have, you know, eviction problems you're having. You're trying to balance all this and maybe sell it to somebody. It could be in distress. It's hard to comp that out necessarily. Could be a very bad time in the market for liquidity. And it just becomes much more complicated on the backup plan, in my opinion. Okay, you may have a different opinion, but so to me, from a risk perspective, I found that the backup exit plan was always the easiest and clearest and easiest to operate and execute on the single family side. So I can't comment on this having invested in multifamily, for example, but I will make another point here. You see all this financial engineering that you're seeing on the slide, securitizing all this stuff, warehouse financing, they're levering it up. People, even on the single family side, have seen returns in the 10 to 12% range on single family first position lending funds in the past 2 to 4 years. Because if you did it unlevered, you'd be in the 6 to 8% range on average. I'm just giving people an average. And that wasn't attractive enough to investors. So prior to probably 2018, 19, if you were investing in a first position loan, you were probably getting 10, 11, 12%, maybe 8 or 9 if you were in like a California type market. But across a lot of different markets, you were getting unlevered 10, 11, 12%. No financial engineering had to take place. This goes back to what I was saying. You're at the end of a cycle. They're taking leverage on leverage, so to speak. And I don't ever invest in that type of situation because now all of a sudden your backup plan gets completely encumbered by other leverage and it's not clear. The risk is significantly higher, even with the 0 to 50% LTV versus owning it yourself first position. So, and to me, I'd rather be in an 8% unlevered return than in a 10 to 12% levered return from a risk reward perspective. Just in a single family debt fund first position specifically. So the reason why I mention all this is a lot of people I think have invested in debt funds without even realizing that they were taking on leverage on the loan that they were providing. They just looked at the returns and they said, I don't want to invest in this hard money fund. It's 8% or 6, 7%. And they just look at 10 or 12%. That one's better. And I trust me, I've seen this happen many times now. And so that's why I'm pointing it out to everybody. Very important to understand that. This goes back to understanding the capital stack. And obviously you'd have to look at the loan terms, where the risks are. We haven't even gotten to any of that, right? The term of the warehouse financing, you know, what does it mean? When can they foreclose on you themselves? All this stuff. So sorry for the long answer, but it's important to take all this into account.
No, I mean, I just liked it because we, at my normal job, we focus here on providing this first mortgage. So I like seeing how they were putting it together, and it's like it seemed interesting, and it seemed okay. I can get 12 to 14% on it, but a lot of the income was coming from the warehouse financing, and then that warehouse financing getting you to a securitization. And so there's a lot of pieces. It's not just like if the pitch deck was 1 page and it was like, all right, we're gonna give this loan at 8%. If they don't pay us, we foreclose on it, and then we sell the house and we get that money back, the principal. That'd be 1 page, right? Like this deck was 50 pages. This is only 1 page of the 50 pages explaining how they got to the 12%. So yeah, it wasn't as straightforward.
And I want to say that I come from experience because I have probably invested in hard money in this single family first position in some form or another, in multiple forms sometimes, since probably 2009 or 10. And I literally stopped doing my lending at the beginning of the year once interest rates started to go up because of the interest rate risk and the risk and asset price adjustments. I'm currently on the sidelines. I'm not in any loans at the moment, but I'm almost always in loans in general. And the 8% number I was telling you about, James, I mean, you can go in at like a true 70% after repaired value LTV, and get that 8% loan. So you're in a really good position if you're in the right market.
Right. Okay. Perfect. All right. Sorry, that went way long, but I appreciate you hanging out, and we'll try to
No
wrap
problem.
up with these two slides. So these have no pictures. So GP best practices. So when you whether it's invest in a deal, what are some of the things that GPs do that separate them from other GPs? Maybe give us 3 things, best practices that you've seen GPs do.
Okay. Best practice number 1, conservative assumptions. Okay.
Everybody's conservative, Jeremy. Every underwriting is conservative.
Yeah, well, let me tell you, the passive investor's job is to look at a presentation and determine if they've really been conservative or not, to understand who you're making a bet on. So that's LP best practice number 1, right? But GP best practice on conservative assumptions. GP best practice number 2, proactive, regular communication with investors. Now, whether that means you're responding relatively quickly but reasonably timed to investor questions, whether that means you're providing detailed quarterly reports, whatever it is. I have literally seen deals go really well for investors, but the communication was so bad or so lacking that people then could not invest with them again, most of the investors. And that, to me, is one of the worst things that can happen for a GP after actually executing well and doing all the work, right? And obviously, the worst thing that can happen is poorly executing, fiduciary issues, all kinds of fraud, Ponzi scheme, and there's much worse. But I'm saying, if you're going to perform well, for God's sakes, don't have such bad communication that people don't invest with you again. That's crazy, right? But that happens. And I've seen it happen more than once. So that's best practice number 2. And best practice number 3, I would say focus. So what I mean by that is, whether it's you're focusing on one asset class, maybe 2 maximum, or focusing on 1 or 2 or 3 markets or whatever it is, if I see someone who has expanded to 10 markets very quickly, or someone who's expanding out to 4 asset classes very quickly, that is a huge red flag, because you're setting yourself up for a higher probability of not being able to manage everything well. Whether it's because you don't know the markets, you haven't gotten the team there assembled and putting more risk onto investors, or because you don't understand those asset classes well enough, you just don't have the experience. So focus is definitely a huge best practice as well.
All right. Let's flip over. This is the last one. LP best practices.
LP best practice. I'm going to go to my number 1, which is tear the assumptions apart and and understand whether, just at looking at the assumptions and how the verbiage of what you receive in the deck, even how it's written and what it says, is somebody conservative or not, and who you're looking to make a bet on. LP best practice number 1. Best practice number 2, always keep in mind that who you're making a bet on is more important than the deal itself. The deal itself is a close second, but don't lose sight of that. Don't get enthralled by a deal, because you can have the best operator with, the best property with the worst operator with a very bad outcome. And it didn't matter that you were in the best location in Beverly Hills that was fully occupied. It literally would be foreclosed. So that is best practice number 2. Best practice number 3, and this is something, unfortunately, I don't find enough people do, is I'm going to throw 2 in here, okay? One is background checks on sponsors. Always run a background check. But even perhaps as equally or more importantly, if you're fairly new and you come to the table and say, I'm really interested in this type of investing, I want to get some cash flow, I got to get started, I want to get started. My first question back to you, if we have that conversation, is going to be, what is your opinion about where we are in the cycle? And if you don't have a good answer for that, take a step back, hold off investing, and formulate an opinion. Your opinion is your opinion. It's not wrong, not necessarily right. Nobody knows. I gave you guys my opinions across. I could be wrong about everything I said here, but I have an opinion, as you can see. And I'm sticking to that opinion in terms of how I'm looking at investing and deploying my capital. You have to understand where we are in the market, because I tell people, you could have invested in the best property with the best manager in 2007 in the best location and be foreclosed in 2010. And you can invest in the worst property with the worst manager in the worst location in 2010 and made a boatload of money by 2017. And I'm really not exaggerating. That has happened to people both sides. So timing is critical in investing in, especially in real estate and other types of assets. And when you're giving someone control, you have to be sure you're getting in at the right timing, because once you give them your capital and you sign the documents, they have control. So one thing you can control is the timing of when you're going in and what your opinion is about whether it's a good or bad time to invest. I feel that too many people come in and they say, I've got this money, I've saved it up. What do I got to deploy it now. Rather than saying, does it need to be deployed this year just because I have it, or should I wait a year or two? What's going on in the market? Is it the right time in the market? And that is a very important best practice.
Well, Jeremy, I definitely went a little bit longer than I expected, but I appreciate all the feedback on these are slides that I look at every day. This is stuff that people have sent me in the last like 30 days. So I appreciate you giving me feedback on those things. And if we had an hour at my conference, at the Old Capital conference, I would have you up there for an hour. But since we didn't, I appreciate you coming on and doing a little bit of a show for us today. And if people have made it this far, they obviously are interested in what you have to say. So what is the best way for people to reach out to you?
Yes, God bless anybody who is still on with us here. Thank you for hanging through the whole thing. Easiest way to reach me, anyone's welcome to reach me, is my email, which is jroll at rollinvestments.com. So JROLL at Roll Investments, which is ROLL Investments with an S.com. So jroll at rollinvestments.com. And James, I want to thank you for having me today. I really hope this is helpful for anyone who listened to it, honestly.
All right. Thanks a lot, Jeremy.
Thank you.
All right. See you. Bye.